Welcome to this edition of Fuel for Thought. I'm your host, Guido Vildoso, and today we're tackling a topic that's reshaping the landscape of the automotive industry: how tariffs, EV policies, and consumer behavior are colliding in some surprising ways. Since May of 2025, U.S. automakers have been navigating a challenging environment. 25% tariffs on imported vehicles and parts, shifting emission rules, and the upcoming expiration of the EV tax credits. That is a lot. But interestingly, while tariffs have created uncertainty, the immediate impact on pricing has been less dramatic than initially expected. In today's episode, we'll unpack why and what OEMs are doing to manage costs. We'll also examine the impact of changing regulations on electric vehicle adoption and what this means for the industry's trajectory. Joining me today are two experts: Stephanie Brindley, Associate Director, Automotive Intelligence; Matt Tromer, Associate Director, Innovation, Product Management, and Industry Performance, S&P Global Mobility. They will provide their perspectives on these pressing issues and share their thoughts on what lies ahead for the industry. So let's jump right in. Let's start by setting the stage. What's changed, and how are automakers reacting behind the scenes? Stephanie, can you provide an overview of the U.S. trade policy changes since May of 2025 affecting the automotive industry? How have these impacted automakers' pricing strategies?
Good morning, Guido. Thanks for having me on. Yeah, since May, we now have a 25% tariff on most auto imports, on full vehicles and on parts. And that 25% actually is 27.5% for most countries, because there's also what we call a most favored nation tariff that is of 2.5% that's on most everything. And so that means any imported vehicles have a 25% tariff. And as well as that, there is a tariff on imported parts. For most countries, it's about the same. So anything you're producing in the United States is also more expensive. We have tariffs now on steel and aluminum and copper, which also increase the cost of producing a vehicle in the United States. Interestingly, the steel tariff is 50%. The metals tariffs are 50% on imported metals, but it also increases the cost and the price of steel in the United States. The prices inside the country are still getting higher, because even though you're not importing it, they have more price possibility and they're increasing the prices that way. So you've got a lot of reasons why the cost of creating and producing, importing a vehicle is higher. We expected that automakers would transfer that cost to consumers pretty quickly. We expected to see more production changes than we have initially. And it's been really interesting watching automakers play the game really steady. They've really just been patient and taken a wait and see approach. For consumers, this is good because prices haven't increased the way that we expected that they would. For companies, it's not great because profit margins have been affected, earnings have been affected. There's billions being spent on tariffs, and it is definitely changing that landscape.
Thank you, Stephanie. Matt, what are you observing in terms of vehicle inventory levels, particularly for imported vehicles versus domestically produced vehicles?
Yeah, sure, Guido. After 3 years of continued steady growth following shortages due to COVID, we see advertised inventory in general decreasing in this year. After reaching a peak of a little over 3 million vehicles at the end of November last year, our retail advertised inventory is now down to 2.7 million. It's a 15% reduction against last year's peak and down 5% year over year, which is a bit of a change since what we saw right after COVID and some of the shortages. We heard many times in the past few years about how manufacturers and dealers didn't want to go back to the pre-COVID inventory levels, and see that perhaps this year some of these uncertainties in the market have really provided that extra push to dampen the increases in supply. I think consistent to what Stephanie commented around them and maintaining a steady course, a lot of what we see is perhaps the manufacturers are being steady, but a little bit on the conservative side in terms of how they're producing vehicles. When we look specifically about advertised inventory for domestically produced versus imported vehicles, there are certainly a few interesting trends to note. We do see advertised inventory models built in China down 45% versus the end of March, with the Lincoln Nautilus and Buick Envision both down significantly. Though it is a lower volume vehicle, of course, Volvo announced that they would discontinue sales of their Chinese-produced S90 due to tariffs. And we do see in some cases how manufacturers have shifted the source of their inventory. General Motors, for instance, builds the Chevy Silverado and the GMC Sierra in several plants in North America. Sierra inventory sourced in Mexico is down 34%, while U.S. produced Sierras are up 18%. Silverado advertised inventory is down everywhere from March, but U.S. source inventory is down only 9%, while Canadian source inventory is down 50%. Hyundai has also shifted some production from their Tucson from Mexico to the U.S., and Mexican source inventory is down 65%, while U.S. produced Tucsons are up 20%. The reality, though, is that such flexibility in production location is not really widely present today. Manufacturers typically can only decide whether they adjust their production to limit the impact of tariffs while potentially not having enough supply to cover critical segments of the market, risking the loss of sales and loyal customers for the future.
Thank you for those powerful insights. Stephanie, you mentioned that automakers have absorbed costs rather than passing them on to consumers. Why do you think they have chosen this approach?
I think that's a great question. And I think that a lot of this has to do with the fact that we don't know precisely what the tariff is going to look like in a few months. And up until now, we've got a little bit more certainty in the last 3 weeks than we've had for a while because we have tentative agreements with the European Union for dropping down the autos tariff to 15% for both vehicles and parts, and same with Japan. So we've got a little bit more certainty there, and we get quite a number of vehicles from both of those countries and both of those regions. And South Korea also, we have a pending agreement with South Korea to go to 15%. And those are still much higher than what they used to be because we had a free trade agreement with South Korea. So vehicles being imported from South Korea had a 0% tariff, and Japan and the European Union, I think, were both at 2.5. So they're both really low. So 15% is still going to be quite a bit higher than we used to be. But when those actually come into play is still a little bit of an open question. They're still doing 25% today. And so they haven't really come into play. And there was a lot of discussion starting probably about March through September when these finally got to be a little bit in the Federal Register and executive orders were issued. So there's a little bit more clarity there, but we still have a lot of uncertainty around the USMCA trade agreement. Canada and Mexico both have 25% tariffs on parts and autos. There are some carve-outs for vehicles and parts that are compliant with USMCA free trade agreement already. And doesn't take it down to zero for most cases, but it does give a little bit of relief in that scenario. So all of this uncertainty and not knowing exactly what tariff is going to hit, not knowing for sure how long it's going to last, has caused automakers to kind of wait and see. You don't necessarily want to have an uncertain pricing environment for the consumer. You don't want to change your prices every other month. And there's some pricing changes that happen throughout the year. They don't necessarily stay steady from beginning of the model year to the end, but you don't want a lot of change. If you have too much change, you certainly throw off consumers, you throw off residual values, and you confuse the market. And they don't really want to go in that direction. So not knowing exactly where they need to be, they've just decided to hold off and play it steady for right now. And another reason for taking that approach as well is the impact of tariffs is different on any vehicle and for any automaker. And if you, as an automaker, say, I'm going to increase by whatever for tariffs, you signal to the consumer something they don't want to hear. And also you have the potential of creating a pricing advantage for your competitor. If your competitor either doesn't need to adjust that much for tariffs or they don't have that cost in the same way, you've given your competitor an advantage to be able to sell at a lower price. And that also has potential for hurting your sales.
Thank you for those powerful golden nuggets. Let's elaborate a little bit more. From a business strategy standpoint, what are the trade-offs that OEMs are making to avoid passing those tariff-related costs onto consumers? Are we seeing impacts on margin? Matt alluded to changes in sourcing. Are we also seeing a product mix? What are you seeing out there in the battlefield?
Yeah, we are seeing definitely an impact on margin, as I mentioned. But most automakers have noted quite a large tariff impact on their financial reporting for the first half of the year. And there's going to see a lot more in this third quarter and in the fourth quarter, because as the situation goes on, there's a bigger impact. The 25% didn't really go into play until the beginning of May. So the first half of the year had a lower impact than the rest of the year. Margins were down for most automakers. It was a bit mixed because they're global automakers with other costs and expenses as well. So while tariffs were a bigger one, for some automakers, it wasn't the biggest new expense that they had, but margins have been affected for sure. And we were also on the production changes and the sourcing changes, as Matt alluded to, you can't necessarily do that quickly. So we're seeing some automakers make changes that'll go into effect in a couple of years. General Motors has announced moving around some of its North American production and moving some internal combustion engine vehicles that are being produced in Mexico right now and moving them back up to the United States and some other changes in there. But it'll take a couple of years before those come together. You don't necessarily want to change production in the middle of a product life cycle. You're moving tooling, you're moving stamping, you're moving a lot of equipment within the plants, and it's much more efficient to do that at the same time as a model change, not in the middle of the cycle. So they want to time that out in just the right way. And also moving sourcing means moving your supplier network with you as well, or at least as much of that, because if you move the main manufacturing, but you still have to import your parts and everything is not close and you're still not very efficient. So changing sourcing takes a lot of time. And we've seen a little bit of that, as Matt talked about, but we're going to see more of that later. And that is the easiest thing to do. In terms of product mix, we've seen a little bit of that. But I think when we come into 2026 model year vehicles, we're going to see more of the mix and shift change. And that's an example. We've got the Audi A3 where they've decided for 2026 model year to simply drop the base model. So that the vehicle, if you look at the just sort of the pricing line, it went up by $3,000 or so. But if you look at the model mix, the base trim level was just no longer available. So the price for the next trim level up didn't vary too much, but that still looks at it that way. So you're seeing that. You're seeing things like Ford on some trim levels of the Maverick did things like they made the power rear window on that truck an option instead of a standard feature. And so there's moving around things within the mix that is happening. And I think we'll see a lot more of that happen. And I think on an inventory basis, probably see automakers be much more careful about making sure they're stocked with the trim level that the consumers tend to want. You don't want your inventory sitting out for too long. And where you've got a tariff situation on top of that, you certainly don't want inventory that's not going to move very quickly.
Thank you, Stephanie. So much going on, certainly a lot of fluidity from an industry standpoint. And I can't help but think about the expiration of the EV tax credits, 30D and 45W, coming in at the end of September. Matt, how is EV inventory looking like these days? Is it moving faster? What should we anticipate the OEM reaction to be once these incentives expire at the end of the month?
Yeah, sure. There certainly does appear to be some evidence the EV inventory has been moving faster recently. When we look at the data in contrast with the overall advertised inventory, electric vehicle inventory in the US really showed steady growth in the first half of this year. It grew from 145,000 vehicles at the end of January to 190,000 in the middle of June. That's a 30% increase, again, contrasting with the slow, steady decrease in the overall market. But since the week of the 16th of June, so the middle of June, we see EV inventory steadily falling and is now down to only 129,000 at the end of August. This is a 24% decrease year over year, again, versus the 5% we see for the overall market. And again, this is also despite the presence of over 30% more EV models in the market. We see more vehicles coming out, but lower inventory. As a result, days supply of electric vehicles has fallen to only 67 days by our measurement. That's down from 122 days in mid-June. Conversely, day supply of gasoline vehicles has risen from 82 to 94 days in this time period. So there's certainly a lot more movement for EVs compared to the overall market. We do see this reduction in supply for EVs as a consequence of both reduced inventory levels we see and also an acceleration of sales. Our estimates suggest that retail sales of EVs in July and August were up over 40% compared to a year ago. And I think also a lot of this is very strong evidence of anticipation of the expiry of these tax incentives. The top selling models in our database, only the Ford Mustang Mach-E, Cadillac V-Stick, and Escalade IQ, as well as some of the recently launched vehicles, the Kia EV9 and Hyundai Ioniq 9 are showing more inventory compared to June. Everything else is down, mostly significantly. It is clear that many manufacturers are certainly expecting a slowdown in EV sales. The tax credit expires later this month.
Thank you for that. Message is crystal clear. Stephanie, can you share your expectations for EV sales in the US moving forward?
Certainly, when we look at that, we're going to see a slowdown in the fourth quarter. It'll probably be a hangover into the first quarter of 26 because the first quarter of the year EV sales have traditionally for the last couple of years not been as strong. So we're going to have an adjustment. Consumers, the $7,500 tax credit on leasing in particular has been really helpful. And what it's really done is enabled an automaker to get an MSRP and to get a price for the vehicle that's closer to profitability. Most EVs aren't really profitable at the price even that they are. And the tax credit was helping to bridge the gap between something where a consumer is willing to pay and the automaker could still get closer to profitability. And without that, we're going to have to wait and see a little bit whether consumers are going to adapt to the new pricing or how much automakers decide to incentivize or what kind of programs they decide to run. It'll be complicated because I noted that most EVs are not profitable today. So if you're not profitable and you try and add or make up or bridge the gap of the $7,500 and particularly again, leasing credits, that's going to be a difficult push in some ways, but you do still want to keep the market going and you do still want to keep your sales up. And so it's going to be a difficult one to navigate. Looking at inventory and production, as Matt said, automakers are already talking about being careful about that. We do have announcements from Volkswagen and from Cadillac and from General Motors about production cuts already for the rest of the year and changes that are in that. GM has a plant called Fairfax that's going to start producing the Chevrolet Bolts by the end of the year. They were going to put a second shift. They're going to delay that. There's some production slowdowns that'll happen in the Spring Hill plant, which builds some internal combustion engine vehicles, but it also builds the Acura ADX and the Cadillac Lyriq. And then you're looking at the Factory Zero plant, which builds the Cadillac IQ and the two Hummer products and the electric trucks. That plant is going to take some slowdowns. So we're already seeing some of that management in there and trying to find the right balance. And what we'll really start to see in a lot of ways is where for the natural consumer demand is in this pricing. It's going to be a slowdown. We also do think that electric vehicles are something that consumers are increasingly interested in. Prior to the discussion of the credit going away and knowing exactly when it would go away, EV sales were continuing to grow, although the share had started to plateau. And if we think about EV adoption and then the growth of the EV market being a very long-term trend, seeing it plateau at some points and then come back up again is a pretty logical process to see. Electric vehicle sales were unlikely to be a straight up trajectory for, ad infinitum. So the plateau isn't super scary, but seeing the pricing impact on top of that, and also probably talk about there's other regulatory changes that are making internal combustion engines and vehicles and hybrid vehicles easier within the U.S. regulatory framework as we've taken away some penalties for missing fuel economy. So you get a situation where producing the hybrids and the internal combustion engine vehicles is ending up a little bit better for automakers and for consumers. So we're seeing a little bit of shift there. It won't go as fast as it used to, as the industry and sort of as regulatory environment wanted it to go, but it's still moving. There's still plenty of interest in electric vehicles. They are interesting. They can be fun to drive. They can be easier to live with once you've made that change. So we do think that it's going to continue to grow, but not at the same pace. And our forecast is continuing to evolve, especially at this particular point right now. But we're thinking that in 2030, we're 18 to 20% EVs, which is different from a couple of years ago when there was hope that we'd be about 30 or 35% EVs in 2030. So we're slowing it down, but it's not going away.
Thank you. It sounds like car companies are definitely facing a storm. It's almost as if the industry were facing a reset as a whole between balancing tariffs, EV slowdowns, and changing buyer expectations. Stephanie, let me ask, what are some of the key factors that OEMs are considering in their pricing strategy as they navigate this reset of the industry?
That's a great question to talk about. I think one of the situations that I can think about as we talk about this industry and we talk about what the challenges are and tariffs and regulations and the political environment, these are things automakers have dealt with for the 100 years they've been around. The challenge now is we've got a high tariff environment that we haven't had for an incredibly long time. And that has had a drastic impact on the cost structure. And we're looking at a global sourcing structure that has developed over decades, and especially the North American market, sourcing wise, over the last 30 or 40 years, has developed to be a very efficient process overall for making vehicles across the globe. And we're changing that by introducing tariffs. We're changing where the source points are for cost and how that is coming together. And that's changing the way that we think about it. But at the same time, these are also factors that automakers and suppliers have always had to work with. What are you doing at the end of the day? You're building the customer vehicle that the consumer wants, that the consumer is interested in, that the consumer sees enough value to pay for it. And how you lever that out to get to the right space has always been a bit of art and science. The fundamentals of what we're doing are the same. What is the challenge is this high tariff environment that is shaking up what we had as a very efficient cost structure. So we have to figure out how to work within the new cost structure. When we look at pricing on that too, then yeah, it's a lot of what we've thought about before. It's some of the stuff that we've talked about here in terms of changing what your mix is and trying to figure out where consumers are most interested in. And I'd say automakers generally, model year to model year, will make minor changes in trim and content. So even doing that is not something that's never happened before. It's not a new trick in the bag. You kind of always look at that. If you've got a model line, what's the percentage of take rate of the base model versus mid-level versus top? And when dealers give their feedback and consumers give their feedback, which features do consumers really care about? And there's movement around in there to make sure that the margins are where they need to be, to make sure that consumers are paying what they want to pay and they're getting the product that they want. We're still going to see that happen. That's still part of this process. It's just a little bit more difficult with higher tariffs that we didn't expect this to happen necessarily a year ago, and certainly weren't expecting it to be this high. So I think that is a lot of it. You've got to get to a point where consumers are still willing to pay. And at the same time, we are going to have to price this increase. Where is going to be the interesting part? I think automakers are going to be looking at spreading costs across their global footprint as much as they can, spreading it between different parts of the organization, increasing costs a little, increasing pricing a little bit someplace else that might be able to absorb it so that it can offset having to lose a little bit of margin in the US and not raise the prices as high as to cover the costs just out of that market. So we're going to see some things like that. We've already talked about some sourcing things that we will see. You'll see mix changes. We may see some other low volume vehicles being imported away, like Matt mentioned with the Volvo. We may see a little bit more of that. It's still, at the end of the day, it's trying to find that sweet spot between what a consumer is willing to pay and value and care about, and you being able as an automaker to still make money, because that is still the business.
Thank you. Matt, how do you see this impact, this reset, playing out with inventory management?
Managing vehicle inventory can certainly be challenging, even without much of the uncertainty we're seeing in the market today. The manufacturer wants to optimize their manufacturing output to ensure a steady production of new vehicles and cash flow. To do, they need a solid understanding of consumer demand as well as all the factors affecting their costs. They don't want to produce too many vehicles that will have difficulty selling and then have to provide significant rebates to move them. Conversely, they don't want to have shortages in availability with the potential to lose sales in the short term, and in the longer term, potentially some of the loyal customers that might go to their competitors. The external forces we've been discussing today have been hitting manufacturers in all directions. The expiration of EV tax credits have both a short-term and a longer-term effect on consumer behavior. Tariffs, and particularly the uncertainty around them and their effect to product costs, create a different set of challenges, particularly in an environment where most manufacturers have very little flexibility to shift production in order to minimize the effects of these higher tariffs. Consequences that they must assume measured risks to manage their costs by reducing production or holding vehicles outside the country for a short time in expectation that tariffs are being reduced. Again, it's a very challenging environment. And again, we see a lot of wait and see approach at the moment, and manufacturers hanging on as they can until they get more and more certainty, certainly taking the decisions to invest in a different production in different locations. All the logistics around that are very expensive decisions. And certainly in the environment that we have with the uncertainty are ones that the manufacturers at the moment are not really taking to a great extent.
Thank you, Matt. Let's begin to wrap this up and talk about the future outlook. If we're looking ahead, the industry is clearly at a crossroad. So we need to start thinking about what is coming next. Stephanie, what are the biggest challenges and opportunities for automakers as they plan for the next 12 months?
In the next 12 months, probably the biggest opportunity is we might get a little bit more certainty around tariffs. And as we get closer and closer to understanding what that is, the option there is to say, okay, what do we do? We know what, now that it's settled, we can start executing some changes, because I promise you, these automakers have not just waited to see, even though they haven't necessarily done pricing and haven't pulled the trigger on some physical changes to happen yet. They're not waiting and seeing in terms of not understanding what they need to do. So as you get a little bit more clarity in the situation, you have the opportunity to take action that you've been delayed on doing and starting to move forward on that. And we're going to have to talk to consumers and explain a little bit more about what's happening with pricing. And the consumer seems to be fairly robust in the sense that we're still looking at a 16 million unit this year for sales and 26 or 25 for the US, which we didn't think was going to happen a couple of months ago. We thought we were going to pull back. So consumer buying still seems to be there. And if you can find the right mix, they still want to do that. The other challenge that we have over the next 12 months is one that we've really been struggling with for a couple of years, and that's vehicle affordability. We have seen MSRPs not go up and in some cases come down a little bit this past summer, but it's still really high. It's still at that $48,000, $50,000 for an average vehicle, and interest rates still remain high. So for consumers, the pricing is still a big hurdle to get there. You have to be able to afford roughly a $700 a month payment in order to get into a car. And that's a challenge for growing the market. That's a challenge for helping to get some more entry level buyers into the market, which grows you in the future. So I think pricing and affordability, is still a significant challenge. There's a potential for interest rates to come down. That will be a big help. But other than that, we're really kind of pushing that affordability concern is still a big concern. If we could address that a little bit better, we'll probably have a stronger market. But again, automakers can't sell at a loss in order to address that. So that, I think affordability is probably one of the biggest challenges. Once we settle down and have a better understanding of what the tariff situation is, and once automakers start saying, okay, maybe it's going to be a 25% tariff, maybe it's going to be a 15% tariff, but I'm going to start taking action, just understanding them in a high tariff world. And then we're not going back to a low tariff world anytime soon, and start behaving that way. We're going to see some stability in automaker actions.
Thank you, Stephanie. Any final observations from Matt?
Yes. Thanks, Guido. As Stephanie said, certainty is really, I think, the key word here today. There's a great degree of uncertainty in the market. Everybody is striving for some degree of certainty. Ultimately, manufacturers will always want to lobby and plan for policies that most benefit them and work in as favorable environment as they can. But certainty is really the key to take some of these hard decisions they have. Having the certainty in tariffs, and if they are in a higher tariff environment, will allow them to develop or to implement a clear plan to mitigate these negative effects while capitalizing on any resulting advantages they might have in the market. Uncertainty just results in temporary and half measures, particularly when decisions being made are relating to these large investments and structural changes. So it is certainly possible, and I think we can all hope that such clarity will emerge over the next several months, but it would seem more likely that the environment will remain challenging for the industry. Could be just the start, but certainly it's going to remain to be a difficult situation for manufacturers over the next several months and likely into the next year.
Thank you so much, Matt and Stephanie, for joining us for this episode of Fuel for Thought. Today, we delved into the intricate dynamics of the U.S. automotive industry amidst the backdrop of tariffs, evolving regulations, and shifting consumer preferences. As we look ahead, key questions linger. How will manufacturers balance the pressure of tariffs and the need to remain competitive? What innovative products and approaches will they adopt to maintain consumer engagement and confidence in their offerings? We extend our gratitude to our experts for sharing their knowledge and perspectives. And thank you, our listeners, for tuning in. Don't forget to follow us on LinkedIn at S&P Global Mobility and explore our products and offerings at spglobal.com/mobility. We'll be back with more episodes of Fuel for Thought next month. Have a wonderful day.